I think, yeah, I mean, it's a clean high, 44,305 now. We got to about 44,330.15 on the Nifty Bank. All right, just a few other names before we move any further. We can have Nucleus up. I mean, you don't see volumes like this at all on a name like Nucleus, but is there 17% on volumes. ICICI Lombard, I mean, when's the last time you've seen this name up 10%? Again, right up there with tremendous volumes. Engineers India is up 3%, 108 in that one. Karnataka Bank is up 3%, 148. ICICI Pru Life is up 5%, 466. We got Nagarjuna Construction, NCC, about 3.5% higher. And I can go down, but volumes and Quest Corp and PTC and Repco Home. Repco is up about 7.5%. But volumes are still kind of obviously a little low for this at this point in the day. Clean Science is down about 2%, 1407, 1408 on Clean Science. I think numbers have been under pressure. ONGC is down a full 4%, and you got Sun Pharma, which is down 1.5%. City Union Bank is down 8.5%. Balakrishna is down 7.5%. Aurobindo is down 3%. Greaves Cotton is down 8%. So I mean there is enough activity on the downside as well. And I'm only looking at things with volumes at this point in the day. So it's pretty active right out of the gates. No questions. 1,500 stocks are higher, about 500 stocks are lower. So there's absolutely no doubt which way, the scale is tilted towards. It's on the upside. Very close to new highs on the Nifty as well. The banks, of course, the banks index making a new high in any case. Saurabh Mukherjee is with us. He's founder at Marcellus Investment Managers. He's joining us on the program. It's been a while, Saurabh. Great to have you with us here. Thank you very much for your time. We speak at a time when we're almost at new highs, Saurabh. But I just want your sense on earnings and how the fourth quarter earnings and what you've heard from companies, your portfolio companies and others. What's your sense and feel been like for how F524 is, what we should expect across the board? Go on.
I think by and large, the picture we got of India Inc. Basis fourth quarter was that by and large corporate India is humming at the moment. There are a few spots of weakness. I'll come to that in a minute. But if you look at, say, the banking sector, the top lenders, banks and non-banks are growing at 20-25%. The life insurance sector growing at mid-teens. The IT services sector, whilst the slowdown in the Western world, the close to sort of the brush with recession of the Western world, lowered revenue growth for the IT sector, the deal wins were uniformly strong. So if you look at sort of TCS or Infosys, or indeed the engineering R&D services, one of the best quarters from a deal wins perspective. The capex cycle plays, we don't have too many capex cycle plays in our portfolio, but say if I look at L&T's order wins or Cummins' revenue growth, Siemens' order book, it looks like the capex cycle in India is humming. The only spot of weakness that I could see in the fourth quarter results was discretionary consumption, not small ticket this time. Discretionary consumption seems to have hit a pocket of weakness. I was looking at TTK Prestige's results. I was looking at Jubilant FoodWorks' result, in our own portfolio, Page Industries' results. I don't have an easy answer for why discretionary consumption has hit a bit of an air pocket. Is it because job creation in the IT services sector, in the tech sector has slowed down? That's something we'll have to look at in more detail. But leaving that specific aside, by and large, the picture is of a humming economy. And if you consider the fact, Prashant, that this is an economy humming after a year and a half of rate hikes, I think the outlook is extremely positive. Not just in terms of foreign fund flows. I spent 2 weeks in America meeting institutional investors. I think the outlook for foreign fund flows is very buoyant. But even from a macro standpoint, I think we're looking at a pretty healthy FY24, both from GDP growth perspective and from earnings perspective.
Okay, well, I just want to mention that the stock of the moment right now undoubtedly is Mahindra & Mahindra, and a lot of brokerages have raised their earnings estimates and target price on the stock post the numbers. So it's currently at 1338, but on an average the prices are anywhere between 1500 to 1600. Morgan Stanley is at 1472, Macquarie is at 1546 in terms of target price. Motilal Oswal is at 1500. And the one thing that, I think people are quite positive on is the fact that M&M has raised their capex guidance for the auto segment to 9,500 crores, from 7,900 crores earlier, and for the EV business. So, Saurabh, hi, good morning. You were talking about the pickup in the capex cycle. We are seeing companies do that, right, like Mahindra and Mahindra, because they are quite bullish on the entire revival in the auto space. But do you think a lot of that is in the price, especially for some of these names?
I mean, look, we don't own Mahindra, but if I take, say, let's take a straightforward example. Let's take a big Marcellus holding, HDFC Bank. They've been growing their loan book consistently at 22-23% for 20-25 years, Sonia. And if a company consistently grows at 22-23%, both sides of the balance sheet for a quarter of a century, it's difficult to say that the stock price fully factors that in. I think the last 4 years, HDFC Bank would have compounded about 4% share price compounding, in spite of the business compounding consistently at low 20s. So difficult to say that, with India's best franchises, the share price fully reflects the upside. You guys were just discussing ICICI Lombard. We've owned it for the best part of a couple of years. It didn't do much, and then this morning it jumps by 10%. So that's the nature of investing. If you invest in quality names like ICICI Lombard, we've owned it for a fairly long time. You just have to be a little patient and wait for the market to realize that the upside isn't factored in, and then you get value crystallization. I'm sure those people out there who are owning an HDFC Bank type stock, you will get your value realization as well. Quick disclaimer on names like HDFC Bank, ILOM. I own it through Marcellus' portfolios. So do our parents. So do my parents, and so do our 10,000 clients. So just thought I should make that clear.
All right. Hi, Saurav. Good morning. Good hearing your thoughts as always. Saurav, I recall in the past you had a view on Balkrishna Industries. Is that part of your portfolio?
No, we don't own it. In my erstwhile avatar as a sell-side broker, we used to cover it. Obviously, very interesting franchise in off-highway tires, but we don't own the name.
All right. No, it's getting a hard knock now, and it's down close to around 8% also. We'll keep that one at the side for the time being. But Divi's Laboratory, the last time you joined us, you said you believe in the franchise. You've kept saying it, you'll have doubled their position, if I remember correctly. What do you do the stock at these levels? I mean, the call has worked out. Yes, there are some decisions that don't work out, but this one has worked out well. And the street is reading this margin recovery as a positive. Your view on the stock from these levels?
I think, Nigel, there's a long way to go before I can say the call has worked out. We doubled our position in November, December. So I think Jan of 2022, Jan 2022, it was 2.5% of our portfolio. Now it's close to 7-8% of our flagship portfolio consistent compounders. We also added it to our mid-cap portfolio. We added it to Rising Giants earlier in the year. And our view is relatively straightforward. This company is the world's 5th largest manufacturer of active pharmaceutical ingredients, the largest in India. As is evident from reading the newspapers, there is a big shift globally away from Chinese API. Chinese API is 90% of the global market. There's a shift away from that towards Indian API. In the Indian context, the global majors that we talk to keep highlighting that Divi's is the most credible manufacturer of active pharmaceutical ingredients. And therefore, we felt that when November, December, the stock got needlessly pounded, we thought it was a sort of early Christmas gift, and we have loaded up. We hope to make manifold returns on this in the years to come.
All right. Saurabh, what about Page Industries? That came out with a shocker. Outlook is, well, rather muted.
Yes and no. So we've been expecting this to some extent. We pared back the position somewhat. So if you look at 2022, right, the other undergarment companies got absolutely hammered. So I was looking at the other undergarment companies through the winter. They were down 50, 60, 70% in terms of profits. So to some extent, it was inevitable that Page 2 at some stage would get sucked down by the deflationary forces which have hit the undergarment sector. It's quite bizarre, right? In our country, even undergarments seem to go through a cycle. But that apart, I think what's very encouraging for us is the fact that these guys are going ahead and implementing ARS, auto replenishment system, which obviously reduces the inventory in the system. That's a good thing in the long run. But obviously, when you implement tech, when you implement ARS and you reduce the inventory by a month, it's going to hit you that quarter. So Page's point of view, and we'll need to do more work to validate this, is if you adjust for the fact that they've implemented ARS, sales are broadly flat, which I think is a good outcome, given how badly the rest of the undergarment players were pounded through 2022. And there was clearly over-earning in the franchise courtesy loungewear, as all of us sat at home for 2 years. We clearly bought more shorts and track pants and sweatshirts than we would have otherwise. as you come out of COVID, we buy a few more shirts and come to office. So you're going to see a little bit of that taken away. So in a way, Dr. Lal and Divi's, just think about the Dr. Lal Divi's cycle. This is a little bit of a mini version of that. So you stick to the companies like this, and if the stock comes out meaningfully, we will think about ramping the position up. Great franchise, but I think what's happened in the fourth quarter results was not a particular surprise.
Saurabh, you did mention that you've held ICICI Lombard for some time in your portfolio. So this is, the price reaction is in response to the announcement that ICICI Bank will take its share up. But as a business, do you expect, it's underperformed, right? There were huge expectations for the last so many years. But I guess some of the segments they're exposed to, autos, health, there was COVID. The performance was subpar and the share price suffered. So I want your thoughts on, actually, not just ICICI Lombard, but in life insurance as well, which has, again, not done very much for the last 4 or 5 years. Share price performance. What are your expectations on both?
I think what Bhargav Dasgupta and team have done really, really well over the last decade is they've been very careful about underwriting, right? When prices soften, when rates soften in a sector, when excess capital enters the sector and rates soften, these guys pull back. So it's similar to the sort of capital allocation skill set that Senuday Kotak deploys in Kotak Bank. Think of Bhargav Dasgupta and ILOM team as the capital allocators par excellence in general insurance. When rates soften, they pull back. So their big call over the last 5-6 years has been anything to do with agri and crop. They are not interested in writing, right? And as they have throttled off big time on agri and crop, obviously that part of the portfolio has shrunk. In motor insurance, they remain the market leaders both in terms of profitability and in terms of market share. In motor insurance, they are in a way the pioneer and the Indian equivalent of, say, Warren Buffett's Geico. Their weaker division was health insurance. The insurance regulator made a bunch of regulatory changes last year that's allowed ILOM to ramp up the health insurance business, which is now growing at around 30%. If they can catch up with, say, a Bajaj Allianz and say India First Starter in the health insurance sector, if ILOM can catch up in the health insurance sector and therefore build two strong businesses. The motor business is already very strong. On the health side, they can catch up. I think we'll end up once again seeing a business with 18-19% ROEs, growing the book at 18-19%, which I think is tremendous going in a general insurance context, right? So good company, very clever underwriting, very smart capital allocation over an extended period of time, deserve a lot of credit for that. And I think the market will gradually give credit courtesy the ICICI Bank's move to ramp up their stake. On life insurance, slightly simpler. In life insurance's case, we've seen LIC consistently lose share. And amongst the private sector insurers, it's really SBI Life and HDFC Life who stood out. SBI Life, a little bit more of a quasi-asset management. HDFC Life is your pure protection play. Again, even under the current management, not just under Amitabh's previous reign, but even under Vibha's reign, our return on embedded value has been in the 18-19% range. They've grown the business at 18-19%. Consistent growth in high teens. I think they dealt with the budgetary setback, the FM announcements in the budget, they dealt with it very well. And I think if you look at private sector life insurers focusing on protection, to our mind, HDFC Life stands out.
Okay, all right. Saurabh, thanks so much for stopping by, filling us in with your take on a whole host of stocks. Wishing you a good day ahead and looking forward to having a chat with you in the near future. Well, time to move on then. There was some weakness that we saw in Sundaram Finance performance for Q4. That's if you compare it with its peers. There was a decline in net interest margins, although there was some improvement in the asset quality. Mr. Rajiv C. Lukchan, the managing director at the company, joins us on the show. Hi, sir. Good morning. Thanks so much for joining in. Well, for the past quarter, dispersals were a bit of a degrowth. AUM growth was a little bit soft. And NIMS, there was a mild compression on a sequential basis, though you had hinted at that in the past. Give us an outlook from here on. Will dispersals pick up? And what is the guidance you can give us for FY24, both on the AUM growth side as well as on the NIMS? Please go ahead, sir.
Good morning, Nigel. Thanks for having us on the show. At the outset, after 3 years of quite a challenging period for the economy, we've had our first full year of uninterrupted operations like most of the economy. And I would say this has been a year of resurgence. The fourth quarter in particular actually been quite strong. I'm not sure I fully agree with some of the characterization that you have just made. We've had the highest disbursements ever in our history. Overall, AUM has grown 17% after relatively flattish performance over the last few years. Asset quality is at a near all-time best performance of 1.66% gross stage 3 and 0.86% net stage 3. And profits have grown 20+%. We've had our first 1,000+ year net profit year in our history, adjusted for one-time earnings. So for us, it's been quite a satisfying year, and the fourth quarter has actually been a pretty strong quarter in our assessment. So I'd love to understand, specifically what you're looking for by way of...
Mr. Lokchan, we're just comparing it with a couple of peers. If you compare it with Chola's and the Shriram Transport as well. In comparison, so we get that point, that the numbers are fairly satisfactory and fairly good. But if we just put up, comparison, that's the only reason that we say it could be a little bit softish in comparison to them. But you obviously have your reasons, so you could run us through that. And you could give us an outlook from here on as well on this good performance as per you. What can you guide? Yeah.
Nigel, let's do the peer comparison. And I would just request all of you to do a peer comparison with a balanced view. You've got to look at growth and not only growth. You've also got to look at asset quality. You've also got to look at sort of profitability and operating margins. And the easiest way to look at the balance across these three is to look at the return on assets. And if you look at the return on assets, we've a closed return on assets of close to 2.9%. Our peers, any of the names that you picked are lower than where we are. So to our mind, at the end of the day, that return on asset metric is what we're optimizing for. There is a set of net interest margin fee income you can earn, which gives you the revenue. There's a set of operating costs that you work with, and then there's asset quality that you have to drive. Balancing these three is what I think every institution attempts to do. When one focuses on one particular metric a little bit more than others, it then gives a different characterization. As you know, and we've said many times in the past, we are marathon runners, right? So we are running a marathon, which is a steady, systematic, consistent pace that we set. We'd like to strike a good balance between growth, asset quality, and profitability. And we think that's what we are doing quite systematically.
All right. No, absolutely. Point taken. Very well explained as well. So the sum total of all of it will reflect on the return on assets. And point taken there, Rajiv. Good morning. Now, could you tell us what is the incremental cost of funds for you at the moment? How do you see that panning out into FY24?
So, Prashant, as you know, the last year we've seen a 250 basis point increase overall in the repo rate. That is obviously transmitted for someone like us who relies on the capital markets almost immediately. And so we've seen nearly 120, 130 basis point increase in our cost of borrowings. We've tried to balance that out by transmitting the rates, by focusing on the right customer segments to price the risk well, and to get the right balance across the different asset classes that we work with. Some are sort of low-yielding assets, others are high-yielding assets, so we need to get the right portfolio mix. Net of that, I think our spreads are down about 19 basis points, which I think is expected and back to pre-COVID levels. As all metrics have moved to pre-COVID levels, the spreads are also moving to pre-COVID levels. And as I mentioned in your show in the past, I think for the system, we should begin to see that over the next 4 to 6 quarters. Looking ahead, we do see a relatively stable interest rate regime. I think inflation is sort of somewhat under control, it looks like. That's what I don't want to jinx it. And therefore, the posture that the Reserve Bank has articulated seems to be one of sort of cautious optimism that inflation will come under control, and therefore interest rate hikes may not happen. That said, I think global macro tends to be quite complicated. I think US inflation remains quite firm at 5+%. I think their personal consumption was a little bit of a surprise, growing quite nicely month on month. So I don't know how the Fed is going to react, and therefore the reaction of our regulators to that is something that we'll have to wait and watch. But we expect a relatively sort of calmer and a quieter front on the interest rate and therefore cost of borrowings. So we'll see how this year pans out.
Okay. So do you want to give us any kind of, outlook as far as the net interest margins is concerned? Once again, coming back to peer comparison, and I get your point entirely that, it doesn't make sense to compare on one parameter. But even on net interest margins, at a time when you have seen your margins decline, other peers have seen it, your peers have seen it rise. Just trying to understand, sub 5% currently, what is the outlook for FY24?
Morning, Sonia. As you know, and we've mentioned multiple times, we don't give a guidance or an outlook. I think what we would like to ensure is consistency in what we've created post-COVID over this past year in terms of that consistency in growth, quality, and profitability. I think the simplest way for us to ensure that we deliver that is to transmit the cost of borrowing as best as possible, price the risk that we're underwriting as best as possible, look at the right customer segment mix in each asset class we operate, and get the right asset mix across all the asset classes that we're operating. If we do that, we think we will maintain a historic, long-term, steady sort of cost spreads in the 4.5% to 5% range, which is what we've operated over the last 15 to 20 years. We don't look quarter to quarter and make comparisons, right? So long-term, that's where I think we'd like to ensure that our spreads are.
All right, Mr. Lokchan, the market is full of opinions, and good to hear your clarification as well on that, and we take that on board. But there's no debate on the Sundaram Home Finance part of the business. That has done very, very well. How do you see that shape up from here on in terms of an AUM growth? Or you could give us a couple of targets out there?
Nigel, again, I think it's been the new management team there has had a first full year of operating as a team, and we're seeing the results of that team executing very well. As you know, we've doubled down a lot more in southern India, tier 3, tier 4 markets, where housing demand continues to remain quite robust. There's a fair bit of technology, digital, and data that team has brought into bear. And you're seeing the combination of sort of focus on growth and diversification, as well as productivity and efficiency beginning to play out. We expect that to continue. I mean, housing has a long runway in India, and we'll again expect a similar kind of GQP balance that organization will also strike.
Sure. Okay, we will let you go on that note. Thanks a lot for joining in, and hopefully the next time we speak, the numbers will be much better than what you've delivered this time around. That's the hope. So we'll, touch base with you again very soon. That is the management of Sundaram Finance. But let's move on now. Samvardhan Motherson came out with their numbers last week, and it was a strong set. The revenue saw healthy double-digit growth. The margins expanded, while the net debt has also declined. Pankaj Mittal, who's the Chief Operating Officer at Samvardhan Motherson, and Kunal Malani, the CFO of the company, join us now to talk about that. Gentlemen, morning to both of you. Kunal, I want to start with you. The year has ended very well. It's a revenue growth of almost 23% that you've seen in FY23. Sitting on this base, what kind of growth do you see in FY24? What are you penciling in?
I'll keep it simple. Hello, can you hear me?
Yes, go ahead.
Okay, I said I'll keep it simple. I think hopefully we will beat this record next year as well.
Okay, so when you say beat this record, right, I mean, you're already sitting on a high base of over 78,000 crores. What could the growth be? Is it a 20% growth that you're looking at? Could it be much better than that? And what are the growth levers for the company in the year to come?
Look, in our view, there are tailwinds that are still playing out. I think some of our markets continue to do well. Europe and North America continue to do reasonably well. The premiumization effect continues. The disproportionate share of EVs that we have in our order book is also going to be helpful. And then we have a host of M&As that we have announced, which will all be getting assimilated in the next year. So all in all, I think it's going to be, on the top line, certainly a much better year going ahead.
All right, so we should work with a 25% growth for next year?
Difficult to fathom. It's not that the world is very predictable as yet. But as I said, I think we should still be doing much better than where we are.
All right. Now, I had a question on the margins, and let's focus on just that. Was there any kind of one-time compensation that you got for the higher costs in the previous quarter and the past quarter? If you could clarify on that aspect.
Not a one-time. As we have said again and again, we've been in discussions with the customer to pass on some of the inflationary cost structure that have now become the so-called new normal in the industry. Okay. A lot of that has happened. As you mentioned earlier also, we were working through to get some price increases from the customer, which has all been, to a large extent, been embedded in the annual results now. So I guess the best way to look at it is how we have done annually. I think that gives a good reflection of where we are, and hopefully we will improve from there on.
Okay. All right. The vision systems business, I think that's been the kicker, because the revenues on a sequential basis are more or less flattish, but the margins have improved by 300 basis points. And that seems to be the kicker. Now, you're telling us that these margins are sustainable. So which margin should we look at? The Q4 margin or the average that you did for last year?
I think the best way to think about it is the average that we did for the whole year. That is more reflective in our view of where we stand right now. Going ahead, we should be able to still see improvement from where we are on an year-on-year basis for sure. That's the way at least we see it, because as we said, we've got price rises during the quarter at different points in time, and those are in some way embedded today into what you see as quarter-on-quarter improvements. Going ahead, I think we will shift towards a more year-on-year improvement construct, because that will be more reflective as the markets evolve and the cycle again takes its turns.
So because of Sure. Can you give us some range because of premiumization that you mentioned, as well as energy costs have subsided? You're trying to pass on raw material costs as well. You're trying to do some price hikes with respect to customers. Do you think you can get into a band, a double-digit band as well? I mean, you've increased your margins to about 9%. Are we looking at 10 to 11% in the quarter to come? How much expansion do you see in margins?
Again, difficult to put it in those constructs. On an absolute basis, you should still be seeing improvement. I think that's the way we've been functioning. The absolute is important for us because we're an ROCE-focused company, and ultimately to generate ROCE, it's not the percentage margin, but the absolute with the certain amount of capital that we invest is what we need to look out for. And that's what we're really focused on. If that results in double digit, yeah, for sure, we'll be very happy. But that's not really the focus. It's an outcome. The focus remains an absolute growth in bottom line.
Okay, got that. We have Pankaj Mittal, who's the Chief Operating Officer as well, who's joining in. Mr. Mittal, I want to talk a little bit about the EV programs, the electric vehicle programs, right? The share of EVs in the business is now around 6-7% by the end of FY23. And EVs give you better content per vehicle as well. So just want to understand, what's the eventual game plan? How much will electric vehicles be as a part of the total business? And how much will this help you grow your content per vehicle?
See, if you look at our booked orders of about 5.7 lakh crores, 20% of them are from the EV vehicles. And that gives a reflection of how the customers are thinking. The actual volumes as they pan out will, over the years, will depend on the different markets, different geographies. And as you mentioned, definitely the content per vehicle is much higher in EVs. So we are working, it showcases that our products are liked by our customers. It also showcases the kind of cooperation with which we are working with all our customers across the world.
Is there any scope, Mr. Mittal, to bring down your debt further? Because your debt this time has gone down by almost 11% quarter on quarter. Still quite high at almost about 7,500 crores. Any plans to bring it down?
So that's been the endeavor of the company to continue to improve. And as the supply chains are easing out, the direction has been that how we can optimize more on our working capital in our inventories. And on the other hand, you see that we are also being given multiple chances by our customers to acquire various businesses and to grow the business. So it will be a mix from that point of view.
Okay, all the best. Thanks a lot, gentlemen, for joining in and speaking to CNBC-TV18. All the best for a great year. That's an optimistic view coming in from Samvardhan Madhasan. They say they'll do better in FY24 than they did in FY23. Premiumization is a big positive for them, and they are working to pass on some price increases to the customer as well. So a lot of things working in their favor. Let's slip into a quick break. One of the big movers of today, in fact, the biggest Nifty gainer is Mahindra & Mahindra. We have the management, Rajesh Jujurikar, will be joining in to talk about their earnings. Stay tuned. Well, the market is in fine shape. No problems here at all. The Nifty is now 116 points higher. The good part is we haven't seen any profit taking just yet. And the Bank Nifty holding on to its gains as well. The stock of the moment undoubtedly is ICICI Lombard. 12% higher actually now after ICICI Bank has decided to raise stake in the company. That's looking good. And the market is in a mood to reward good earnings. So something like a Med Plus, which delivered very good earnings last week, is seeing some follow-on buying this morning, up 4.5%. And M&M is actually the stock that is the top Nifty gainer this morning after reporting a very strong performance. Rajesh Jejurikar, the Executive Director and Chief Executive Officer of the auto and the farm sector at M&M, is joining in now to help us understand what went so damn right this time around and what's the way forward as well. Rajesh, thanks a lot for joining in. Appreciate your thoughts. I'm going to start first with the overall business because this time around, it's been really strong for you and you ended FY23 on a pretty strong wicket. Not just that, you're one of the top 25 automakers in the world now with a net profit of over 10,000 crores. So that's a big milestone as well, right, from a global perspective. Tell us a little bit about what the growth triggers are for FY24. I noticed that you've also raised your capex guidance for the full year, both in autos as well as in electric vehicles particularly too. So what is the big trigger and what kind of growth are you seeing for the business in FY24?
Sonia, thanks for having me on the show. Pleasure to be here. And, actually, we were not tracking this measure that you just spoke about. Being in the top 25, I think ranked 22nd company on global auto profits. And in fact, I saw that report come out of CNBC. Thanks for tracking that. For the achievement of 10,000 crores of PAT in this year is quite a significant achievement, quite a significant gain. And we look at that on a full year basis. That's a 56% improvement in the company's profit after tax. So that does feel very good. It's on the back of many things that the business has done. It's on the back of a very strong auto performance, improvement in auto margins, good growth and market share gain in tractors, and margin improvement in tractors, apart from multiple parts of the group as well, kicking in to deliver a strong performance. So, thanks for putting that out there, and we really feel good about being amongst the top profit drivers. To your specific question on how do we see F24 and the whole electric piece, we have firstly on the auto business we have a very strong order book, over 290,000 open bookings, and we continue in the SUV side to get bookings of 50,000 vehicles per month. So it's a very strong order book, very, very strong demand for our brands. And we would see that momentum continue. We expect the SUV industry as an industry to grow a little over 10% in F24, and we would, I'm sure, gain market share in the year. We are ramping up our capacity. We've already reached a capacity of 39,000 per month. And there are plans to get that to 49,000 or so as a capacity by the end of the year. So the auto side is very positive. SUVs, we've gained market share. Light commercial vehicles, which is where we play, that's less than 3.5 ton segment. Also, we've gained about 5 share points in the course of the year, and a comprehensive new pickup portfolio, which we believe will make us stronger in the marketplace. Last mile mobility, electric three-wheelers have done extremely well and had a very, very strong growth. So, all the parts of the auto business have done extremely well.
So, Rajesh, you said SUV industry, sorry, I just want to come back to that. You said SUV industry will grow at over 10% in FY24. What would this mean for for M&M's overall auto business? What are you looking at? I'm asking because, when we speak to your peers like Maruti, they speak about low single-digit growth for the industry. Overall, I think there's about a 5 to 7% growth that the street is talking about for FY24. Your views here, do you think inflationary pressures are something that could affect sales in the months to come?
Yeah. So, Sonia, just to clarify, I think when you hear the industry growth numbers from other peers in the industry, they talk about everything, including passenger vehicles. Since we don't play in the overall passenger vehicle space, we play in SUVs, which is now 50% of the passenger vehicle space. we expect that industry to grow at about 10%, and we would expect to do better than that. So the 5 to 7 number that you may be hearing is for including passenger vehicle. And I think there is some stress at the lower price points, which is the reason why the overall passenger vehicle market is not seen to be very buoyant for F1. Does that answer your question?
Yes, yes, it does.
All right.
So coming to the tractors. Sorry.
Yes. Go on, sir. Go on, Rajesh.
No, happy for you to come.
No, I was going to ask you about tractors. On tractors, I mean, could you give us some estimate? I think you sold a little over 4 lakh units in F523. What should we expect in F524?
Yeah, so actually I was just coming to tractors, so thanks for the lead into that. So tractors did see a good industry growth. Industry grew, I think, around 12%. We grew around 15%. We gained market share. Actually, we gained 3 share points over the last 2 years. We expect the industry to be in low single digits this year. It's because it's also on the back of a very high industry size of 130,000 plus industry size. So there is a very strong base on which to build. In tractor industries and projection that you got to keep changing and updating as you get more data through the year. Last year too, we started with a fairly cautious tone. We had said it would be low single digits, but then we saw the industry momentum pick up very significantly starting the festival season last year, which is September, October, and the industry actually ended up with 12% growth. So, this is something that in the tractor industry space, multiple factors drive growth. The sentiment, the rains is one part of it. And of course, government spending in rural areas, both agri and expenditures, is also a key trigger point. So we would watch this, but right now, it's just at the beginning of the year, we are being a little cautious about and pessimistic maybe about the industry growth at around what we are saying, low single digits. But we do expect to gain market share, and we would expect our growth to be higher than.
All right. Good morning, Rajesh. Good to speak to you. Well, tell us a little bit about that. What are the levers you have with regard to gaining in terms of market share? Elaborate the Swaraj Lightweight platform. How big is that market? And how much can you get? Also, in Mahindra Oja, what will that do for the company? Is exports a focus? How large can that get? So on both these 2 points.
Yeah, great. Nigel, good to see you and good to chat with you. So we have, conventionally the size so far of what is called the lightweight tractor market in India has not been that big, but it's not that small either. So it's now about 50 to 60,000 tractors per year. And our share in that segment is lower than our average market share of 41%. So there is an upside for us to gain share. Both the brands, Mahindra and Swaraj, will come out with the lightweight series. On the Mahindra side, that's been called Oja, and that's going to be revealed on 15th August as a global launch, because it would also help us gain volumes and market share in several other global markets. North America is one, clearly, but also it is an opportunity in ASEAN. We don't play in ASEAN at all today, and that is a lightweight tractor-driven market, and there is a very good upside for us to export and build business in ASEAN as well, and many other parts of the world. So Oja is a strong global opportunity. It's actually 4 tractor platforms, not 1. And we will be phasing out in India to begin with, though it's a global launch, but to begin with in India and then going into other parts of the world by the time we come to the end of the calendar. The Swaraj lightweight tractor series, I'm not going to say too much about it because we're going to launch it this Friday, 2nd June. And again, Swaraj has a very, very little presence there, and we would see Swaraj gaining market share out of this launch.
The other part of the question was on market share overall, right? 41% is what you've closed in at. There's scope to gain further?
Yeah, exactly, Sonia. There is scope to gain further because we've got an entry into new segments. We are also launching an upgraded Swaraj, which has been rolled out in 5 states in 1 horsepower category at the moment. But through the course of the year, we will have the upgraded, new styled, and better lift capacity, better engine efficiency kind of product, which is rolling out across. So multiple initiatives. The Yugo Tech on the Mahindra tractor brand, which is mainstream, would also help us continue to gain market share. So we are very optimistic about gaining market share in tractors in the course of this.
Okay, I just have one last question. You know, in both these segments, right, autos as well as tractors, you are still shy of your pre-COVID margins. So if you look at it in the farm equipment segment, you did about 16.7%. Pre-COVID, you used to enjoy 19-20%. And in autos, you're at about 7.3%. Pre-COVID, your margins were about 8%. Given that there are benign cost pressures now, you're guiding to outperform the market. In FY24, do you think in both these segments you could get back to pre-COVID margins?
Yeah, so just two data points to compare on your question, and we this time put out a comparison of our margin trends compared to F19, because that was a good year with a very, very low commodity price, and commodity price inflation actually started to the calendar year 2021. So firstly on the auto side, our F19 margin was PBIT percentage was 7.8%. We are in this quarter at 7.3%, which we think is coming really close to the 2019 margin. As we've explained in the past, when you have very high commodity inflation, the denominator goes up because your prices have gone up, so your denominator goes up. Typically in an inflationary environment are not able to pass the margin on the actual cost. So 17.3 is pretty close to 17.8 now. So that's been a significant shift, and we moved from last quarter of 5.4 to 7.8, if that yes to 7.3. So that's a very significant movement, driven a lot by internal cost efficiencies. As commodity softens, of course, there will be an upside to the volume without giving a guidance, but we would see upside to our margins as we get into a commodity down cycle. When the commodity down cycle will kick in is not sure, but the same thing will apply on tractors. So on tractors, our F19 margin was, and we for the first time put out our tractor margin separate from the overall farm equipment sector, because that also has a farm machine segment, and that is something we're investing in for a 10x growth in the future. So on core tractor margins was 18.3%, which is comparable to 19.7, and compared to even sequentially, that's gone up quite a bit from 17.5% to 18.3. So we're seeing a very good margin trajectory, and we would of course put in all the efforts and levers to continue improving our margins.
All right, Rajesh, we'll leave it there. Thank you very much for joining us. So things are looking good, even tractors, which you said, I mean, you used the word pessimistic, but then you said, a lot of moving parts there. And in the last few years, maybe things will be better than, what projections are looking like, which is low single digits at this point in time. I guess with the M&M, the only question you need to ask as investors is, what are you willing to pay for it? Because, I mean, growth and outlook, etc., seems to be pretty solid. And you just heard from the management. By the way, the stock's exactly in the middle of the range. The high today is, 1350. The low is about 1300. And we're at about 1325. So bang in the middle of the range. But it's a big, it's come off the highs as well. 18,590. We're up 90 points on the Nifty. So on the market, also there has been a bit of drop-off which has come through. Mitesh is with us with, anything fresh he's seeing out there on the screen and any fresh recommendations. Mitesh.
So, Prashant, the fresh trade in the index will come from possibly the Bank Nifty. I've talked about it. Given the fact that we opened slightly higher, try to buy it around 44,300, keep the stop at 44,100, and 45,000 could be the target area. On the stock side, PFC is something which I would recommend as a buy with a stop below 172. Targets of 185 can be looked at over here. And the other one which I like is again a banking name. A buy on Kotak Bank with a stop at about 1940 for targets of 1990.
All right. Thanks a lot for that, Mitesh. PFC moving to the high point of the day as we speak. Time to slip in a short break, but on the other side, we'll try to add a little bit more color. We'll get chatting with the management of Axo Nobel. Stay with us.
Okay, welcome back. The markets come off a little bit from the high point. We were up 130, we are up 90, 92 points now. So things have cooled off, overall, but still looking pretty good this Monday morning. Now to the numbers from AkzoNobel. The company's gross margin expansion in the fourth quarter led to overall operating profit growth in the quarter. Revenue growth in the fourth quarter lagged when compared to what we've seen from peers, which have already reported numbers. Rajiv Rajagopal is Managing Director at the company. He's joining us now to take some questions. Mr. Rajagopal, good morning. Good to have you with us here. Thank you very much for your time. So let's just start with, with paints, its top line to start with. What kind of volume growth did you see in the fourth quarter? But more importantly, what are your expectations from FY24 on the volume growth front?
Good morning, Prashant. Good morning to all the members there. So as far as last quarter is concerned, yes, aggregate we grew at about 10%. All our businesses were in a similar range. On paint specifically, we had a high single-digit volume growth. We still have a bit of a price increase, which is sort of coming off, which has been accretive to our EBIT margins and our sort of performance overall.
Sorry, what was, did you give us a number for 24? What are you expecting?
So we are looking at a double-digit volume growth because going forward, we do not, given the sort of way the raw materials is panning out, Prashant, we see largely a volume-led sort of performance going not just for 24, but even for a couple of years ahead.
Early double-digit or, high, it's not closer to the 20%, 15% plus?
Well, Prashant, so let me first put it as double digit. We don't get into specifics on segment, as you know. But suffice to say, look, I think when you look at our last year full year numbers, we ended up growing closer to almost 22%. So really, we've been, one of the fastest growing players, in the industry. We've gained market share significantly on a full year basis. And our intent is to continue to be in the top 2, top 3 players in terms of incremental growth. So that really will sort of, if you work backwards, will tell you where we are sort of gunning for.
All right. Hi, Rajiv. Good to hear that you've outgrown the industry, as you say. And I think last time we chatted, you said you're in number 4 position and you're looking to get into the top 3. Could you give us an updated market share? I think you were in that 5.5 to 6% odd with a bigger control, a larger market share in the premium segment. So tell us, what's the market share? Where's it headed?
Hi, Nigel. So yes, so first let's look at it. Even if you add, in this industry, given the size of 6 billion, 6.2 billion, you gain about 0.1, 0.2. So we've gained about 0.2% market share on a full year basis, right? So yes, we dial up our premium. Our premium market shares are significantly higher. We've got approximately about 16.5% market share in premium. And even in the last quarter, we had a significant growth in the premium segment. So we are seeing a bit of what you would still call a bit of a K-shape, where we've seen premium growing significantly faster. Maybe that was a little different compared to some of the other players. And that's something that we are working on to really say, how can we continue to grow in mass and economy? Yeah, we've seen significant growth coming in premium and waterproof, but really maybe on the mass end. Mass, the growth largely came because we are driving distribution 2.0, and we've sort of moved into a larger number of towns where we were not present. So really, how do you really dial into those segments which we've not been very aggressive? For 2 reasons. One, the raw material costs obviously have just started getting benign now. And secondly, we had to sort of readjust our portfolio a bit, both in terms of, value-added products where we can make sure that it's a accretive long-term play, given what you're going to experience in the industry in 1 year from now. So that's the way we really position. But if you take a 2-3 year trend, you see, I was a bit disappointed we didn't touch 4,000 crore. I think that's something that personally was ambition. Given when I joined the company, it was just about 2,200. Yeah, so really, that's really the area of focus.
Okay, Mr. Rajagopal, we are running out of time. This is Sonia here. I just had one question, and it's a 2-part question. You're, of course, facing a lot of competition, right, from the likes of JSW, Grasim, JK Cement. How are you combating that? And would this mean higher marketing spends that you'd have to do as a percentage of your sales, which has already gone up to about 3.5, I think about 2% of your business? Do you plan to spend more, and would that eventually put pressure on your margins, perhaps?
So let me answer the second part first, Sonia. I think a valid question. Yes, it is, because ultimately we have to make sure that our propositions are able to withstand the intensity of the sort of marketplace. Yeah, so we are planning to come with, quite exciting stuff for consumers well before Diwali. And that would require obviously a still significantly higher market spend, but I would still say that we would be in the 4.5 to 5 range first before we really start seeing whether we need to get more aggressive, to answer your question. In terms of EBIT margins, look, I think that will get compensated with, because there is a softening also happening. If you look at our current EBIT margins on a full year basis, even in the quarter, it's been a little stronger than some of the other players, the number 2, number 3, etc. So I think we will continue to sort of make sure that we are sort of keeping an eye on the profitable growth story, because that's what we really want to do and make it accretive both in our paints business and in our coatings business. So yeah.
Okay, Mr. Rajgopal, thanks a lot for joining in and giving us a quick take on the demand situation as well as the way forward for the business. That's Akzo Nobel. Let's take a quick break on that note. Good for the markets, good going for the markets. But when we come back, we'll have a special segment. It's the economy. Lata will connect with Jahangir Aziz of JP Morgan and Foo Hin Yap of Standard Chartered Bank to decode the weak Chinese April growth and the industrial output data and its impact on Asian economies. Stay tuned.